And when you're looking for an annuity and you're looking for maximum amount of income, you need to look at Hey, welcome to the Guaranteed Retirement Guy Show. So I get this question a lot. What is a roll-up rate for an annuity? And I've explained it several times, and it can be still hard to understand. So I'm going to attempt to dive in and explain really how does a roll-up rate work. Because annuity companies, they'll say, we'll give you a 7% or even maybe an 8% guaranteed rate of return every single year. And it's hard for us to wrap our heads around that because we're always taught, if it sounds too good to be true, well, here's the thing with roll-up rates, is they are only set up for income, okay? The index, okay, the underlying index for your index annuity will earn whatever it earns. If it goes down, market drops 20%, then the most you can lose is, well, nothing, okay? So let's talk about the roll-up rate. On one side is the index. The index earns whatever it is. Your account balance might be $500,000. Maybe it'll earn up to $600,000 or $700,000 over the years. Then on the other side, you still get the same $500,000, but now the insurance company is saying we're going to apply a 7% roll-up rate, which means we're going to multiply that percentage by your account value every single year. And then we're going to use that to determine your guaranteed income. Okay, so I'm going to show this visually so you can see exactly how the math works. And you'll notice this is for an individual who is 65 years old. Their spouse is 60 years old, and they are looking to invest $500,000 into an annuity, and then they're going to wait to take income for 10 years. You notice the top one is from American Equity, and they give you a 7% roll-up rate. So let's see exactly how the nuts and bolts of this actually work. So let's take a look at a $500,000 premium. You can see that going in, and then you can see it sitting there for 10 years, earning whatever it earns off of the index. You can see the interest crediting rate column, and you notice it's just showing the past 10 years what it's earned. Compared to the last 10 years, your $500,000 might go up to $600,000 over 10 years, which is not a huge amount of growth, but it also is protecting your money against any type of market loss. And you're not doing this solely for whatever that index earns you. In this particular annuity, I'll just be transparent. This annuity is really designed for income, and that's why it's giving you the 7% roll-up rate. So we already know that after 10 years, if we want to take out our account balance, we can take it out. I mean, it might be $600,000, it might be $700,000. And we take that and we do whatever we want with our money. But since we put this money in for guaranteed income, we're going to leave it in there. So let's look at the income-based column. You see that over here on the right. You'll notice that that will grow every single year by 7%. And you notice the first year is a little bit higher, $588,000. It's just because they put a 10% bonus, or they put $50,000 in this account. So it started at $550,000 from the get-go, and then they applied 7% every year after that. So you notice at the end of 10 years, the income value account is worth almost $1.1 million. And the lifetime withdrawal rate, which of course has been rising as well, is 6.68%. So when those two numbers are multiplied together, almost 1.1 million multiplied by 6.68, that's giving you a $72,273 per year guaranteed income for the rest of your life, as well as your spouse's life. If you were to take it as a single income stream, just for your life, then it's usually a little bit higher. So that's kind of how this works. When you're thinking about, the index will make you whatever it makes, and then if the market drops, you're not going to lose anything, but you won't make anything either. Now, during this time, your roll-up rate is still being applied to the income-based value every single year. And that's why you can see that no matter what happens with the index, the account value, if you were to just take your money out, the income-based account rises steadily. And that, to me, is the real value of these income annuities. And when you're looking for an annuity and you're looking for maximum amount of income, you need to look at the roll-up rate. How long does the roll-up rate last? And then you need to look at the lifetime withdrawal rate, which it will be multiplied against to actually create the income that you want. So just remember, if you've got $500,000 and it's earning 7% or 8% every single year for 10 years, you're going to have a very, very high income-based account. And in this case, over $1 million worth. And then they're going to just take that $1 million and they're going to multiply it by a probably 6 or 7% rate of withdrawal. And that is how they determine your lifetime income. So these are very, very valuable. $1 million times 6 or 7% is pretty great versus just having a $500,000 or $600,000 balance multiplied by the same rate. You see, these roll-up rates are really, really important. And that's why if you're thinking about retiring in the next 5 or 10 years, you shouldn't wait. You should put your money into one of these annuities so that that roll-up rate will keep growing your income value account for as long as possible, because that's going to determine a much higher income for you much later on. Just wanted to ask you, if you've learned something or if you got a comment or a question, please share with the community. We'd love to hear from you and would love to answer any questions that you might have.